where people mess up, and you have to be careful about this. Number one, and it all depends on how your county works, but taxes, property taxes. We ran into this a lot when we were in the residential market because somebody bought a house 10 years ago and they were grandfathered in on tax increases because they were homesteaded. Okay, so they had a property that the tax assessment was based on a $100,000 purchase, so they're paying $1,000 a year or whatever. We buy the property for $400,000, and the real tax number that they were paying was $1,000 a year. But is that a good number tomorrow? No, because as soon as it sells and the county gets the sale records, they're going to reassess at $400, and you're not homesteaded anymore, so the taxes go from $1,000 to $4,500. Could that have a significant impact on your cash flow? Yes. Well, now add a zero. Now, here's the other thing. In a commercial property, taxes are usually reassessed on a fairly regular basis on what the city or the county may determine to be the value. But many times when a sale happens, they reassess based on the sale price, because the sale price between a buyer and a seller as an arm's length transaction is a good indicator of value. Isn't that true? So if you buy a building like this and it happens to be assessed at $12 million and you do a $16 million deal, can you expect a reassessment next year? Yes. And that could be a significant amount of money. Okay? So you need to be careful of that. Here's another area where people... Huh? Yeah. No, not directly. Do you have to compensate for a new roof? I'm just going to use the example. If it's a new roof, that's a capital cost, not an operating cost. So if you have to put on a new roof, you will not be able to take that off one shot in the income statement, because it's going to be capitalized and amortized. But you have to certainly say, well, $16 million, but it needs a $2 million roof, so I'm not going to give you 16, I'm going to give you 14. So you have to make some kind of compensation, but you're not going to compensate the net operating income for it. You may look at net operating income with that an increased factor for depreciating that cost. Yeah. Yeah. Yeah, but anytime that you're dealing with major capital repairs, you always take that into consideration. It's just like this building. You know, I mean, there's some major stuff that needs to be done, like tenant improvements, to put a tenant in here, which is a capital cost out front. So you need to take all that stuff into consideration when you're doing the deal. And one of the things that I'm going to tell you is, when you're doing your due diligence, the vast amount of the most amount of time that you're going to spend doing due diligence is verifying income and verifying other costs that might be involved in that property, because those are the things that affect how much you should be willing to pay for the property. Does that make sense?